Okay, now let's just talk first. When you have a business of your own, you want to know. Let's not talk about what the banks want to know. Let's not talk about what the tax man wants to know yet. Let's talk about what you want to know. You want to know, right? I want to know, are you making a profit or are you losing money? Are you making a loss? Okay. Now you might think, but surely my bank statement will tell me that. Because if I've got money in the bank, surely I'm making a profit. And if I don't have money in the bank and I have to go to the bank and ask them for an overdraft, then I must be making a loss. That's what you might think. It is not so. Okay? Because there are certain expenses that you have in a business that don't go through your bank account. Okay? For example, you go and buy a computer and you ask the person if you can pay it off over a year. Okay? Or you see a special offer. 300 Rand a month for 2 years. What's going to go out of your bank account? 300 Rand. But the computer costs you, let's say, 10,000. Now, because only 300 Rand went out of your bank account and you sitting with 1,000 Rand profit, you sitting with 1,000 Rand balance in your bank account, you think you've made a profit. You know what? You haven't, because you still owe 9,700 Rand. So you've actually made a loss. So bookkeeping helps you to see not only how much you've sold and how much has gone out of your bank account, but it also helps you to see how much people owe you and how much you owe people. Because let's say you've got a business that you sell on credit and you say, okay, you can buy this from me, or you've got to pay me for 2 years 1,000 Rand. You're going to bank 1,000 Rand, but he still owes you 9,000, or she. Okay? So the bank statement tells you what are you receiving money and what are you paying. Your books tell you. Yes, you do. You do account for your bank statement in your books, but your books tell you what money have you got in, what money has gone out, who owes you, and who do you owe. That doesn't touch the bank statement. The bank statement doesn't know how many people owe you and how much, and how many people, you were already drifting on to, and how many people you owe and how much. Does that make sense to you? I've got a lot of people who've come to me over years and said, but why can't we just give the taxman our bank statement? Why can't the bank just give me an overdraft or lend me money to buy a car by just looking at my bank statement? And that's why. Because the bank statement doesn't tell them how many people owe you money and how many people and how much do you owe. Okay, so that is what accounting and bookkeeping is all about. Okay, so you as a person who wants to know what your business is doing will profit or a loss, has what we call an income statement. There it is. It says an income statement. So this is the final result of your books, of your data that you put into the system, from your bank statement and from the invoices from your suppliers and from the invoices to your customers. This income statement is the final result of your profit or loss. It doesn't tell you how much people owe you or how much you owe people. The income statement. The income statement simply reflects your sales. There it is, total sales. Okay? There's some other income. This is just the standard way of doing an income statement. So under total sales, this system has got something for you to allocate to sales that are VATable, something to allocate to sales that's export, which isn't VATable, and something to allocate if people aren't registered for VAT. Then all their sales will go to sales excluding VAT, and they can use sales export if they want to. They'll never use sales VATable because they're not VAT registered. Okay. Same with the cost of sales. Now, a cost of sale, a lot of people think, but my salaries, the salaries that I pay, the salaries I pay to people is a cost of sale. No, it's not. Let's say, for example, you are a service company and all you do, like me, I do books and tax and advice to people, okay? And I invoice them for that. I don't have to buy anything to do that. I was born with my brain. So that is a service business. It doesn't have a cost of sale because I didn't have to buy something to resell. If I sell pens, I'll have a cost of sale because I paid 10 Rand for the pen and I sold it for 20 Rand. So the cost of sale is what did you buy, whatever you're trading in. If you're trading in 1,000 different things, the cost of sale will be how much did I pay for those items versus how much did I sell them for. Okay. Then we'll get to the fact that these sales here is not the sales that were banked. You see, this income statement shows you nicely what did you do in March, what did you do in April, what did you do in May, and then it gives you a total for the year. And this particular one is the financial year in South Africa is March to Feb. In America, it's Jan to December. So I've got another system that runs from Jan to December for other countries, and some South African countries run from July to June. Yeah, no, it's like just yeah. Okay, so let's say for example now this business, okay, had sales of 282,000. It's not necessarily what she banked. It's the invoices for the month of March that she issued to clients. So this doesn't show what the split is. What is the split here? What is the split between what I banked and what is the split between what people owe me? It doesn't show it here. It shows it on another report. Okay, so this figure tells you only what did you invoice. Okay, so let's say for example in March, she invoiced Mr. X, but he only paid in April. It's not going to show in April, it's going to show in March. On the other report, what we call debtors, it's going to be waiting there for him to pay. Okay, who owes me? It will be waiting there on what we call the balance sheet for when it gets paid. Then when it comes into the bank account, it's not going to go to sales because it's already in sales in March. It will go to debtors, which is not on the income statement because we can't bring it on the income statement because it's already in. Okay. Cost of sale, same thing. There's lots of little different ones a business can use. Yeah, let's say they sell 15 different things or whatever. We can have it, and they want to record it all differently to know what exactly is the sale for that and the cost of sale for that and the sale for that and the cost of sale for that. Each one has got a.
Like if a big company has different departments.
Yeah, you could also use like that too. And then the department's got a target to say you've got your profit, what we call a gross profit, is only sales minus cost of sales. It's not your net profit after all expenses. So gross profit is your sales over here and your cost of sales. So let's say you give a department a target and you say your gross profit, here's the gross profits. Okay? Your gross profit, and if you look at the formula, it's E9, so there's column E, row 9, minus minus E21, column E minus E21. Okay, so then it will give you your gross profit there. There. Okay. Then you can split it. You can bring all that department sales into here. You can bring their cost sales into here, and you'll get their gross profit. Okay. Okay. So the cost of sales, the same thing. It's not what goes out of your bank account. It's what invoices came from your suppliers dated in March. From the 1st of March to the 31st of March, you put all your invoice, you capture all your invoices. I'll show you where later. And that is your cost of sale for the month of March. When you pay them, it doesn't come into the income statement. It's already here. It goes into the balance sheet, which we'll get to later. Okay. Okay. So there's your sales and your cost of sales, and then it gives you a gross profit, because this person only has VATable sales, VATable cost of sales, because she pays, because she's registered for VAT, she has to charge your clients VAT, and whatever she buys from her suppliers, they're all big suppliers, they're all registered for VAT, she has to pay VAT. So that's VATable sales, people she invoices, and VATable cost of sales, people who invoice her. Okay. And this amount is excluding VAT. Because you don't want to know what your profit is, including VAT, because VAT is not yours. Okay. And that we'll also get to later. Okay, then your gross profit, so it's your sales minus your cost of sales, that's her gross profit for the month of March. Okay. Then other income is for things like, let's say she does something on the side now and again. It's not really part of her main business. We can bring it in there, other income. We can allocate it to there. And I'll show you how to allocate later. This is the final result of that I'm starting with. Okay? I'm going to show you how do we get these figures later. I'm going to show you where do we put these figures in for them to appear here automatically. They appear here automatically. There's no data entry on this. It all comes from somewhere else. Okay. Okay, and then we go down and we say, okay, now what is our expenses? Now you also want to know, you don't only want to know my total expenses for the month was 300,000. You want to know, but what did I spend that money on? Okay, and these are a whole stack of choices. Choices for every type of expense you could possibly get that you would allocate. Now this depreciation, for example, is when you buy that computer. Then you don't, it doesn't go out of your bank account as one amount, okay? And the tax man also says you can't write off a computer. You can write it off immediately. When I say write it off, you can deduct it from your profit, the whole amount if it's under 10,000 rand. Okay? If I buy a computer for 12,000, I've got to write it off over 3 years. And that happens in the balance sheet. Okay, which we'll get to later. So that's another thing that the bank doesn't know. Because if the bank looks at your bank statement, they're not going to pick up the depreciation because it's not coming from your bank statement. You do it in another entry point that's called a journal. It's not a bank, it's not a payment or a receipt. Okay. So there's a whole stack of things that banks want to see your books because your bank statement doesn't tell them everything. Okay. Okay, and there you've got a whole stack of choices. Okay. Insurance, oh, so here's an available one. So if you've got something that isn't on my list, you could use that one. But you don't change it there because there's no data entry on this thing. You change it somewhere else where I'll show you. Okay. And there's all the different types of expenses. There's the salaries, and there's a whole stack of available ones. In case I don't have something that you want, you could use these. Okay. So that's the income statement. And this tells you, have you made a true profit or have you made a true loss? Yes, she made a profit there. It was a nasty month. Made a loss. There she's made a profit. So year to date, she's made a loss. Okay. That minus that plus that is a loss. Okay. So that's the income statement. That tells you, have you made a real profit or a real loss? A bank statement doesn't tell you that. Okay, now let's just take a break